Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm glad to have Michael Oliver with me for an entire segment today. As always, I'd like to remind you to go to Michael's website. It's olivermsa.com, olivermsa.com. Since 1992, Momentum Structural Analysis, or MSA, has provided unique technical research to the financial industry on banks, RIAs, hedge funds, mutual funds, as well as to individual investors. And so Michael's research covers all four exchange-traded asset categories: stocks, commodities, debt, foreign exchange. He talks about those markets briefly here on this show, but in order to really take advantage of Michael's work, you need to subscribe to his letter, which I do. It's an excellent letter. It's just absolutely, I think, it's irreplaceable for me in my way of thinking because of the way I conduct my business. I am not a trader. I want to know if I'm on the right side of a market longer term. Day to day things are going to go against you, of course, but I don't want to be around on the wrong side of the market when the thing really turns in the opposite direction. So, but if you go to Michael's website right now, you can watch a video there in which he discusses what he believes is the biggest trade of the century, which it's derived from his unorthodox style of technical analysis, which is another reason I like to have him. I mean, if he's not just another technical analyst, he has developed his own proprietary methods of tracking the market, which I think makes him very special. Well, he's special not just because he does it differently, but because he's been successful, and at least from my perspective, is the best technical analyst I have ever used. So, Michael, thanks for joining me again.
Hi, Jay. Good to be back.
It's always good to have you, and it's always good to tell our listeners once again, it's olivermsa.com. First of all, I'm just wondering, Michael, just to try to entice people to go there and look, you have a video there that's very informative. Not only do you spell out the market that you think is the trade of the century, but also you explain your methodology, which applies not just to that markets, but to all the markets that you cover. Could you give our listeners a hint as to what market you're talking about? What is the market that you're looking at, the trade of the century?
There's always good trades, and sometimes they're in obscure markets. There's nothing wrong with grabbing those, but the U.S. stock market has set up a momentum structure, meaning when you detrend its price, everybody looks at a price chart when they look at the trends, but what we do is measure the price action in its relationship to moving averages, usually long-term moving averages. And it creates an oscillator. And the oscillator looks different from the price chart. It shows the breathing up and down of the market in relation to that average. Well, in this case, what I showed was two historic markets that we all know about in 1929 and 1987. And they both shared certain very common attributes when you looked at momentum, not the price charts. And there were very large momentum structures, 3.5 years wide. In other words, where when you looked at the momentum chart, the market kept coming down to the mean, the zero line, the 36-month average in this case, and holding. So, it became like a ritual, and it did it 3 times over a 3.5-year period. So we look at the price chart, it's like an upward curving arc, and you can't draw any good trend lines because it's not multiple lows lining up on a trend. It's just an upward curve, sort of confusing to analyze. But when you look at momentum, it's a flat floor. In fact, if you just looked at momentum and treated it as a price chart, you would salivate looking at the pending breakage structure. Well, they broke it in 29 and 87, and they didn't wait around for the end of the month to prove the case. They just went ahead and did it. But the structures were ripe, and they were big, and big in terms of the sideways duration of that structure. It's like having a bridge on the River Kwai. You've got the pillars that support it, and if you attach a satchel bomb to each pillar, you can bring the bridge down. Well, it built its pillars, and they were clear. And both markets, when you look at the momentum charts of those two historic events, they're the same. You can't tell the difference between 29 and 87.
Interesting.
But those were structures that were developed when you plotted price in relation to its 3-quarter moving average. It's a fairly long-term average. It's almost like a 200-day average, okay, in duration. But now we have a situation where we have a 10-year wide annual momentum structure that's built on top of the 36-month average of the S&P. You remember the European debt crisis sell-off in 2011-12? Well, it landed on that level and held. Went back up again. And then in 2016, it landed on it again early in the year and turned up again. And then it landed on it in December of last year with the same precision. It landed on it in 2016 and 2012 and turned up again. This time when you made your new highs, marginally, by the way, above the highs of 2018 in terms of price, momentum was nowhere near reaching the levels that it had seen at the prior highs. So it was non-confirming. So now we have this 10-year wide bridge with 3 pillars planted at the zero line. And the market doesn't know it, because when you look at the price chart, you can't see this structure. It just isn't there. You just have this 10-year-old beast that is now floundering around up here. The momentum, though, is the structure. In order to break the structure, in other words, to break below the 36-month average, or even, frankly, we even think getting 2% over will destroy it. But it doesn't require a lot because that average is rising every month. It's rising about 1%. So, for example, this month it's down in the mid-2600s. Well, you say, well, that's a safe distance below. Well, maybe it is, okay? It's rising, again, about 1% every month, and you don't want to ever visit that number again. Below this structure. You will not hold. The problem is that there are a lot of fundamental analysts out there, major brokerage firms. Blackstone Group is one, Morgan Stanley is another, Wells Fargo, I think, uttered some statements as well, where they're doubtful of the sustainability of this move, and not that they're calling for a bear market, but a correction, the happy word. Well, we argue, and I argue in this video, you can't have a correction. Because the dimensions of what we consider a correction, like 10, 12%, that kind of thing, you can't do that. You go that far, you're going to blow the bottom out of this thing. And that's what nobody realizes when they look at the price chart. They think, oh, we can have a nice correction. No big deal. It's not going to break anything. After all, what was the last major low we made? Below 2350 last December. So if you drop down now to 2650, you're not threatening that low. It's yet a higher low. Problem is, from annual momentum perspective, you're blowing up the bridge of the River Kwai. So that's why we said this is the trade of a century, especially for the stock market, because this is the biggest structure we have ever seen in terms of long-term momentum under the stock market. And when you build a structure like this, our saying is, if you build it, they will come. Okay? That structure is built. I think it's there for a purpose. We'll see. We're monitoring every month. We adjust our numbers. And now, obviously, that's not going to happen in a void. I mean, other markets are going to be doing things as well.
Yeah, for sure.
We know what those markets are, don't we?
Yes, we sure do. Well, there's a long ways down there to the River Kwai, I think, huh? It's a long fall, if I recall right.
It's 300 points, and that's like 12%, and that number gets shorter every day in terms of every month. Anyway, we adjust the numbers up, so if the market flounders around, the number that's going to bite it is coming up to it. There's also some other trigger numbers between here and there that could get you down there. Meaning, you don't have to fight your way down there. We've got some other triggers not far below the current action that will begin a sell-off. And once you begin to stumble, you might fall.
Right.
So.
All right. Well, this is why people should go there. They'll understand if this illustration really hammers home your methodology. I think, it should convince a lot of people that of the soundness of your methodology. I think, and then the proof is in the pudding, as they say as well. Speaking of some of those other markets, this morning I was reading a price analyst. I guess that's how you would characterize him. He was looking at the oil markets and the treasury markets. And he said, "Yeah, we've seen a little decline in the oil market, which would have suggested that we would expect to see treasury yields fall as well. But they've fallen much, much further than they should. And he's suggesting that, in fact, we may be looking at something." His work is suggesting that we're likely to see not a continued decline in yields and rates, but actually the opposite, that we're likely to see an upturn in the commodity markets, and it's going to be awfully hard to see rates continue to decline in that environment. What are you seeing in terms of treasuries and commodities in general? I know you've also been pretty bullish on commodities longer term, and I think longer term at least bearish on treasuries.
Right. We turned positive on treasuries last December. with an expectation of a pretty strong rally up to like 160, and it's gotten above there. We get bullish above 140. This is on the T-bond futures, 30-year bonds. That rally is getting questionable now. Mm-hmm. So, I know there's a consensus out there that, and Greenspan said it the other day, that we're headed toward negative stuff, and, maybe we are, maybe we're not. But we're getting a little technically suspicious of the sustainability of the T-bond rally, the drop in yields, though there is a conviction out there that they're going to continue that way. Not with us. Okay. Now, it's been coincident with the gold market, by the way. The bond surge and the gold surge were almost overlays of each other. Yeah. When you look at the price chart over the last 6 months or so. But I think that will divorce itself as well at some point. And I suspect the divorce is going to come with T-bonds failing in this rally and turning back down, yields going back up. I think the trigger for that is something that nobody's talking about. Nobody believes is going to happen. In fact, they're concerned that the other is happening. The Bloomberg Commodity Index is, our view, the best index to look at for commodities now. It is fairly balanced between the various commodity groupings. It's not overly energy-weighted, okay? So it's a good cross-section. It's been going sideways, boringly, in a range from the low 70s to just above 90 for the last 3 years. It buoyed off of its low 72 area in early 2016. This is when gold bottomed, okay? A lot of commodities made lows then, and it came up. Crude oil had a nice advance between 2016 low and last summer's highs, from like $26 up to $77. And then it collapsed down to 42. So the crude oil was one of the chief contributors to the Bloomberg Commodity Index moving up off of its low from the 2016 low. So was copper. Mm-hmm. But now both of those markets have caved recently with the stock market drop in December. And they tend to swing with the stock market, those two. They're economically sensitive, quote unquote. We've been told that.
Yes.
I think that the crude oil now is situated in a way that it could turn up in a sustainable way. I'm not sure it's right now, but it has the structure to do it. And the Bloomberg Commodity Index has one of the biggest momentum bases I've seen it develop in a long time. My suspicion is that in the fourth quarter, which is 15 days away, trading days, we could get a breakout in the Bloomberg Commodity Index. And it looks like the kind of breakout that could rush 20 to 25% to the upside rapidly. Now, that would shock people because nobody's looking for a commodity price boom. And it has a derailing effect on certain other assumptions. If your assumption is the Fed's going to be accommodative, and all of a sudden they get smacked in the face with a 25% boom in the commodity index,
right?
It's going to cause people to be fearful that the Fed is not going to be accommodative. And, of course, what will be happening to the stock market at that point, and what will be happening to the bonds that everybody's buying, thinking we're going to zero inflation and zero rates.
Right.
So it's a disruptor. I would be watching the Bloomberg Commodity Index because if it can break out, it's saying not just that copper and oil are going to rally, but the broader subsectors within the commodity complex are going to turn up. And that's not something that's happened over the last 3 years. It's been very selective.
Yeah,
but now if in unison it turns, it could be a shock effect.
Absolutely. Nobody's expecting that. Very few people think in those terms, Michael. That's why we like to have you. You bring ideas that are not always in sync with everybody else, and that's, they're ideas that are well thought out. Just one quick question, if you can answer in 30 seconds or so. We're seeing a bit of a pullback in gold. Are you worried at all that we'll...
No, I'm very happy with what I'm seeing. We expected, we put on the board a low this week at 1485. We thought we'd probably see. We got to 1487 today. Maybe we go a little lower. Silver's pulled back to the upper end of a range of support that we thought we would see this week, 1775 to 1750. I think the low today is 1777. We don't think there's much to this sell-off. We think it's more of a congestion zone with ups and downs within it. And I think that if you're a bear on gold and you're expecting a sharp correction, you better see it this week, because if you end up Friday closing gold anywhere around 1,500, give or take, not 1,450, but 1,500, give or take $5 or so, then that's a non-event week, and I think that's the end of the downside pressure that we've seen for the last 3 or 4 weeks.
All right, well, I'll leave it go at that. Thank you so much, Michael, again for your insights. Always welcome, always appreciated by our listeners, and I would appreciate it if the listeners would check out Michael's website as well, olivermsa.com, and seriously consider subscribing to his work. It will be well worth it if you're an investor of any size at all. Thank you so much, Michael, for being with us, and look to do it again next week, hopefully.
Thank you.